Hello, I'm Angie and this is UK Money Wisdom. Today I want to talk about something that many pensioners are starting to notice. Retirement finance in Britain has quietly changed, hasn't it? And it's not because of one dramatic policy, but because of many smaller changes which are now interacting at the same time. Because we have rising state pensions, frozen tax thresholds, higher savings interest, reduced investment tax allowances. We have flexible pension withdrawals and inflation pressures affecting everyday spending. Individually, each of these changes may seem small, but when you place them side by side, something important appears. Retirement income now behaves very differently from how many people expected it to when they spent decades working and saving. And many pensioners are discovering something surprising. They now need to understand how the financial system works in order to manage their income properly. In other words, many retirees are becoming their own financial planners. So, in this guide, we are going to carefully walk through the major financial shifts affecting pensioners around 2026. And after each one, we will look at what it means in practical terms. Change number 1, the state pension is rising. The UK state pension increases each year under the triple lock. The triple lock guarantees the pension rises by whichever is the highest. We all know it well. Inflation, wage growth, or 2.5%. Here is what the current figures look like. In 2025-26, you can see there were £230.25 a week, and in 2026-27, they are estimated to rise to £241 a week. And you can see what that gives in each case as an annual pension. And for many pensioners, this increase is welcome. But pensions do not exist in isolation, do they? They sit inside the wider tax system, which the government uses to its advantage. What does this mean for you? When the state pension rises, it increases your income, okay? But if tax thresholds do not rise at the same time, the interaction between those two numbers becomes important. That is where the next change appears. Change number 2, the personal allowance has been frozen. The government are well aware of this tool in order to control income. So, the personal allowance is the amount of income you can receive before paying income tax. It currently stands at £12,570. It's been like that, frozen, since 2021, and current plans indicate it may remain frozen until 2031. Now compare it with the expected state pension. This table shows you the expected state pension of £12,548, the personal allowance of £12,570 leaves you just £22 remaining tax-free space. And that means the full state pension is now only £22 below the tax threshold. So what does this mean for you? Even very small additional income can now trigger income tax. Examples include a small private pension, savings interest, part-time work, dividends. Many retirees are surprised by this because the state pension itself uses almost all of the allowance. And change 3 is that horrible fiscal drag that we are enduring, which is the quiet tax increase. Economists use the term fiscal drag. It happens when income rises, but tax thresholds stay frozen. And over time, more income gradually moves into the tax system so that the government is controlling how much net income you are receiving, not just by giving you an increase in pension, but by ensuring that the tax will take some of it back. Meanwhile, wages and pensions continue rising, despite the fact that the personal allowance might remain frozen at $12,570 until 2031. What does this mean for you? More pensioners gradually become taxpayers, even if their income tax has not dramatically increased. This happens slowly, which is why many people only notice it once they start seeing tax deducted. Let's look at change 4 and how that affects us. So why do pensioners suddenly see new tax codes? The state pension is taxable income. However, tax is usually not deducted directly from the state pension. Instead, HMRC collects the tax on state pension through another income source, usually a private pension. This means some pensioners suddenly notice new tax codes. Common examples include BR, that's basic rate tax applied, or OT, which means no allowance applied. W1 or M1, they are emergency tax bases. And K code, additional tax collected. What this means for you: if you have a private pension, it may be used to collect tax on the state pension. So, changes in your tax code can sometimes reflect the interaction between these two income sources, and you must be aware of any change in your tax code and see what you can do about it, because there are many things that you can do about it. But let's move on to change 5 first. It's the fact that retirement income now comes from several sources. Modern retirement income often comes from multiple places. You have state pension, we know that's taxable. Workplace pension, we know that's taxable. Personal pension withdrawals, yes, that's taxable. Savings interest, taxable above allowances. Dividend income, yes, taxable above allowances. ISA withdrawals, after looking at my several previous videos, you know this is tax-free. So what does this mean for you? Two people with identical savings can experience retirement very differently, depending on where their income comes from. Understanding the tax treatment of each income stream can help you manage how much tax you pay. Now we need to look at change number 6, and that is that savings interest has returned. Higher interest rates mean many pensioners are now receiving savings income again. Here's an example above. Savings of £30,000, interest rate of 4%. That's an annual interest of £1,200. Now the personal savings allowance for basic taxpayers is £1,000. So, savings interest £1,200, personal savings allowance £1,000, taxable interest £200. What does this mean for you? Well, savings interest can interact with the wider income tax system. If your income is already close to the personal allowance threshold, interest income may push part of your income into taxation. The 7th change is a capital one, and that's capital gains allowance. The capital gains tax allowance has been significantly reduced since 2022-23. It used to be £12,300, and then in 23-24 it went down to only £6,000, and from 2024 onwards the government reduced it to only £3,000. This means gains above £3,000 may well now be taxable. So what does this mean for you? If you hold investments outside ISAs, more of your gains may now fall within the tax system. And this makes the tax structure of investments increasingly important for you. Change number 8 is the flexible pension drawdown, which is now becoming very common. In previous decades, many retirees bought annuities. Today, many people instead use flexible drawdown. This allows pension withdrawals to be controlled. As you can see above, the withdrawal type of 25% pension lump sum is usually tax-free, but remaining pension withdrawals will be and are taxable. What this means for you? The timing of withdrawals can influence how much tax you pay in a given year. Some retirees choose to spread withdrawals across years to manage tax thresholds. Now, if you'd like me to go into detail about any of these things that I've discussed so far, just tell me in the comments and I'll be more than happy to spend a whole video on all or each of them again. Okay, moving on to change number 9, we see global events can affect inflation only too well recently. And that change sits outside the UK tax system, doesn't it? We see global energy prices rising, with geopolitical tensions, including the current conflict involving Iran in the Middle East. This has pushed oil prices higher straight away, and goodness knows how much further it's going to rise. One of the most important oil routes in the world is the Strait of Hormuz, through which roughly 1/5 of global oil supply passes. When tensions rise in that region, oil prices can increase rapidly, which they're doing. Higher oil prices can influence petrol and diesel, heating costs, electricity generation, food transportation. And what does this mean for you and me? Energy prices influence many everyday costs. So changes in global energy markets can affect the cost of living even if your income stays the same. Change number 10. I want to look at how retirement has become structural. The biggest shift facing pensioners is not one single policy. It is the growing importance of financial structure. Two retirees with identical savings can experience retirement very differently depending on how their income is structured, which allowances they use, when they withdraw pension money, whether savings sit inside tax-free wrappers such as ISAs. And this might be a good video that you'll be interested in, but do let me know if any of this strikes a chord with you. And what can this mean for a lot of you? Well, understanding how income flows through the tax system can make a noticeable difference over time. This is why many retirees now take a closer interest in how their finances are structured. So some final thoughts. The financial landscape for pensioners in 2026 is evolving quietly. Nobody's telling you about it. Nobody's telling you how to manage, but manage it we have to. We have rising pensions, frozen tax thresholds, savings interest, investment tax changes, and inflation pressures. They're all interacting together. Individually, as I said, these changes may appear small, but together they gradually reshape how retirement income works and how much tax we pay. Nobody wants to pay more tax than they have to, so let's make sure that we don't. And understanding the structure behind all these changes I've told you about can help people approach retirement with greater clarity and confidence. I know it's complicated, and if you want a simpler explanation of any part of it, do ask me in the comments. I'll be only too happy to make it much simpler so that you do understand. And as I say, I'll be making more videos that can help you. Just give me a thumbs up on which ones you like. Please remember the disclaimer that I need to put out to you. It's that this content is for general information only and is not personal financial advice. It is based on current UK tax and pension rules and public guidance for both the 2025-26 tax year and the 2026-27 tax year. Individual circumstances vary, as I keep saying, and rules can change, so it's important to understand how things interact for you. And if you found any of this useful, please would you subscribe and like the video? And if you know of anybody who is struggling and paying tax on their income, please share the video with them so that it can help them too. And perhaps you could talk about it with them and work out together what's the best way of managing your income. It's amazing what we can do if we share our problems. And I think now is the time that this must happen because we're not getting any advice from the government. That's it from me today. And I shall be back as bright and breezy as I can with another video very soon. In the meantime, please have a lovely day. Try not to worry too much about things and do get your head around your finances. You don't want to throw any more tax at the taxman than you have to. So, goodbye for now.